You've spent years or even decades contributing to your employer's retirement plan. But now, whether you're undergoing a career change or rethinking your retirement plan, you're considering a retirement plan rollover. Whoa, wait a minute, not so fast though. Because a rollover can be one of the biggest financial transactions you make in your life. To help you understand the importance of a rollover and everything to consider before making your decision, we're joined by Foster and Motley Zach Binzer and Heidi Lenhart. I'm Patrice Sikora. It's good to be with you, Zach and Heidi. Thanks for being here.
Thanks for having us.
Thank you.
All right, Zach, why don't you give us an overview of what rolling over an account actually means?
Sure, I'd be happy to. Essentially, it is a transfer of an account that you have established to another account. Typically, rollovers involve retirement accounts. So you may have been contributing to a 401k or a 403b retirement plan while working for company. And for whatever reason, you're at a stage in life where you'd like to transfer that account. And so typically what we see are rollovers to either an individual retirement account or a Roth IRA. Um, or if you're making a career change or an employer change, but plan to keep working, you may also decide to roll your account over to the new employer's 401k, 403b, or other similar type retirement accounts. Um, each and every account or employer plan has unique offerings. So it's definitely a decision you don't want to take lightly and one you want to think through all the details before you execute next steps.
Are there a lot of folks in this situation?
Yes. Some data suggests that over 50% of the US population has funds in a retirement account, whether that is an employer plan or an IRA. So typically, if you've been working for some number of years, whether it's your own dollars you've put into the account or perhaps an employer match that they put into an account on your behalf, majority of the population does have some dollars in a retirement type account and therefore may be faced with a rollover at some point in their financial journey.
All right, so you're facing this rollover. What are your options? What do you have to consider?
Oh, there's a lot of factors. Reasons you may be thinking about the rollover in the first place. Perhaps you're hiring or changing advisors. I've touched on changing of employment. You're approaching retirement. Your employer may be making a strategic change and terminating the retirement plan you're a participant of. Perhaps your company was closed or you were laid off against your will. And then finally, some people consider an in-service distribution where they continue to work, but roll those assets out into a new account type to further their goals as they approach retirement. And that typically has a limitation on it of being 59 and a half years old. But with a lot of what we're talking about today, each plan can be uniquely specific to the employer involved. So I'll just caveat that a lot of what we're going to say applies pretty broadly, but also before you take any action, you want to definitely confirm the specifics of the retirement plan that you're a participant in.
All right. Heidi, talk to me about what you could do if you decide to roll over an account. What are the options you have to look at?
Well, some of the things that you would look at is whether you're going to actually transfer the assets, whether you could actually leave it with a former employer if you desired, and the plan is still active. You are going to be limited in the investment options that you have if you're leaving it with your former employer and plan. But you may also roll it over into your new employer plan or into a IRA that you have opened with your advisor. So there are a few options. You frankly could cash it out if you wanted. I would venture to say that that isn't recommended very often, but people could certainly do that.
And the hang up on cashing it out is typically there are going to be tax ramifications to that. And so rolling a large sum of money out and paying taxes all at once is usually utilized only in very specific circumstances or specific situations. So that's where tax planning and working with an advisor can come in to say, is this the right decision for me to cash this out versus executing a transfer or rollover?
If you were to leave it with your employer, are you liable for fees?
Yeah, a lot of plans do cover the administrative costs with small deductions from the participants' accounts. In addition, depending on the investment vehicles available for the dollars within your account, most plans offer some form of mutual funds or ETFs that can carry with them what we call expense ratios, where the fund managers themselves get a small portion of the dollars that are invested on a regular basis as well. Now, to be fair, that's not unique to an employer plan or a 401k or 403b. Um, Investment costs or administrative costs could apply to any account that you're participating in. So it's definitely worth checking that out as you consider your options for next steps.
Talk to me about things to consider when you might be making that decision to move.
I think one of the first things that you would want to think about is what your options are going to be when you roll it over. Do you have a variety of vehicles that you can be invested? You're not limited as to that specific plan at your former employer in terms of maybe the 5 or 6 mutual funds that they might offer. Maybe if you're rolling it over into an IRA or into your new employer plan, you're going to have more options to diversify your investments.
Yeah, and to
You,
piggyback off, you may also be dissatisfied with the performance of the investments available to you and believe that moving your funds to a different account would open up doors to new investments that may perform better. Or perhaps some people would be interested in annuities or things like that that would provide a lifetime stream of income. Also, we've seen clients retire with old 401ks from 3 or 4 prior employers that they never rolled over. And now, as they enter retirement, they like to consolidate their assets into one account for ease of administration and management going forward. Obviously, being in the wealth management services industry, clients come to us all the time seeking our services. And part of that equation could be rolling their assets over into an account that we can manage on their behalf for them. So there's a lot of factors that would drive someone to consider whether to do a rollover and then what the end result of that rollover might be for them.
I can totally understand the desire to consolidate accounts because keeping track of them, that could be a nightmare, I would think.
Yeah, typically I don't recommend clients keep old prior employer accounts with that prior employer unless there's a very specific reason to do so. Perhaps a unique investment option that they find attractive. Typically, as they change employers, I'd like to see those dollars follow them to the new employer or again to an individual retirement account that they can maintain for the rest of their life.
All right, Heidi. So you decide to go with an advisor to work with you if you want to roll over your accounts. Are there some things that they should be telling you?
they should, if they are following the guidelines that the Department of Labor has set out, they will be providing you with a best interest analysis, which will highlight the reasons why you plan to roll over, the benefits of rolling it over, and then also the costs associated. That should be in some type of a report form that you would be presented and get an explanation so that you have an idea of the implications of rolling it over and how that works in your specific situation. So the best interest analysis by the Department of Labor just is protecting the client for making the best decision that they can with the information that they have as they think about moving these funds.
All right, tell me about the three different types of actions you can take.
So the first one is just a direct rollover. That is where you're taking the funds from your existing plan and putting it into your either new employer plan or a new IRA that you've opened to receive the funds. That is a more simple process than some of the others and typically could just happen with an electronic transfer or a paper check. And as much as we love technology, we find that paper checks seem to be more the norm in these types of situations. But certainly, if you're working with an advisor, they can help you work through the logistics of it. The other one would be a trustee to trustee transfer. And that is where you are asking them to move the payment directly from your IRA to another IRA.
Direct rollover just means that it's staying within the kind of the retirement account realm. But they may issue you the check made out to your new account, but you have to touch it and administer and do something next steps with it. Trustee to trustee transfer, just slight nuance there, is where your current account custodian or where the account is held sends the funds directly to the new account holder. So, for an example purposes, if your 401k is at Fidelity and you would like to roll it over to an IRA at Schwab, a trustee to trustee transfer would be a check sent from Fidelity directly to Schwab. A direct rollover in technicality could be Fidelity mails the check to you at your personal residence, and then you turn around and mail that to Schwab for deposit.
If that happens, though, if you touch that check, are there taxes involved?
There could be, depending on your actions. Ideally, the check would be made out directly to the receiving account and not to you personally. And if we do that, we can avoid a lot of the tax complexities because basically you never were able to deposit that check into your personal accounts because it was made out to your IRA or your new 401k. And thus, you never truly had access to utilize those dollars in any way. There is another transfer or rollover method, the indirect rollover or the 60-day rollover, where the tax ramifications could come in. And in that situation, typically the funds are distributed out of your current account or your old 401k, made out to you. You can deposit that into your personal checking if you were, interested in doing that or taking that step. And typically, if that is how it's going down, the custodian would be forced to withhold some taxes on the distribution. So let's just, for example, purposes, you're distributing $1 million 401k. They make it out to you. They say this isn't a rollover of any kind. You're just taking a distribution. We're going to withhold taxes, and say they're going to withhold 20%. That would be $200,000 of your account going to taxes. So then your net check that you receive is 800,000, and then you deposit that in your checking account. But within 60 days, you say, you know what? I don't need these funds. I really want to do the traditional rollover. I don't want to pay taxes now. I want to get back into the retirement account environment. If you transfer those funds from your checking to the intended receiving account, whether that's your new 401k or an IRA account, and you do that within 60 days, you could avoid the tax consequences. Now, the complication is if the original distribution withheld the taxes and you only deposited $800,000, you have to come up with the other 200,000 that was withheld to make $1 million deposit into the new account and avoid the tax complications of the rollover.
And then if you did that, are you going to get taxed again later on, or does this become like a Roth?
Actually, if you do it in traditional 401k assets to traditional IRA and you move 100% of the value, you should not owe any taxes in the current situation. You would owe taxes in the future if you take distributions later in life. Now, that withholding piece that we talked about in the example, if you bring funds from other sources and complete the $1 million deposit in the new account, you don't have that tax liability any longer. And therefore, the withholding that was done was not required anymore. But it's already been transacted and sent to the IRS. So now when you file your taxes, everything would be reconciled. And in theory, you would get a $200,000 refund if we stick with the example.
That's a heck of a theory. Heck of a theory.
Right. So obviously that last example with the complexities of just describing the transaction is one that we don't typically recommend on a regular basis, nor do we expect a lot of folks to be using that as their primary solution.
All right. Heidi, what are some of the other factors that you need to consider? I'm thinking whether or not any of your assets are vested in your employer.
Yeah, so it's not unusual in my experience for people to not have a complete understanding of how their funds have either been allocated or what has went into the account and what has not. And so that's part of going back to the best interest analysis. We are evaluating what is in the account, and we can also then help you set up whatever type of account you might need to roll the funds over, meaning some of them might have traditional funds, some might have Roth funds that we had just been talking about. And so you need to know what is in your account. An advisor can help you certainly evaluate what is there and what needs to be moved and how it needs to be moved. I'll let Zach speak to kind of what happens with Roth funds because that is a different topic, um, a different idea than most people are used to.
All right, my friend, go for it.
Yeah, happy to help. So, Roth and traditional are designations that most people are probably familiar with, but traditional kind of equals pre-tax, meaning contributions went in, a tax deduction was realized, and then the dollars were available to grow within the account and compound over time, kind of in a pre-tax environment where capital gains, interest and dividends, growth is not necessarily taxed. But later in life, the IRS gives you that tax break up front. But later in life, they say, when you take these dollars out, we're going to tax you on every dollar. So it's a tax deferral. The strategy there is, if you can put dollars in pre-tax now while you're in higher tax brackets, and then later in life, if in retirement you expect to be in a lower tax bracket, you're going to pay those taxes in theory at a much lower rate than while you're working and earning your wages. Roth IRA is kind of the opposite. Roth IRA or Roth 401k, Roth 403b, that Roth word applies to a lot of different accounts. Roth implies that you pay the taxes now. Similarly, all of the assets can grow, capital gains, interest, dividends, all of that occurs year in and year out, but you don't pay taxes each year. And then later in life, because you paid the taxes to put the dollars in, you can take the dollars out tax free. So it's kind of the flip of traditional. And then there's nuance in between. And a lot of the nuance from a 401k or employer plan environment is that typically employees are making contributions to their accounts, but so are employer. So employers may do that as an incentive to keep employees around, as a reward, as sharing the profits. And so typically the employers, when they make contributions, they want to make sure there's some guardrails that this employee is going to continue to work and provide value to the business. So they will put a vesting schedule on those dollars. And some, again, going back to every plan is unique. You want to check your own plan's vesting schedule, but some of them may be cliff, meaning none of it vests until 3 or 5 years from now.
Mm.
Some of them may vest over time where, each year that goes by over 5 years, 20% vest each year. And then at the end of the 5 years, you're 100% vested. So as you're considering a rollover, you may say my account balance shows at $1 million again, but I'm only vested in 900,000. And if you've terminated from your employer, you likely aren't able to vest any further. So while your current statement may show the million, your vested balance is only 900,000. And 900,000 is likely all that you'll be able to execute a rollover with. And then to Heidi's point, if you do decide to move forward, we want to understand of the 900,000, how much is traditional, how much is Roth, because part of the rollover process would be sending those traditional assets to a traditional IRA or a traditional 401k and then protecting the Roth assets and by sending that to a Roth IRA or a
Mm.
Roth 401k.
As an advisor working with someone, do you interface with the employer or former employer, or is it up to the former employee to do that?
We're always happy to, as Zach would say, jump on a call with you and work through navigating even getting verified when you call these 800 numbers and you're trying to work through things. But at the end of the day, it's your money and the plan is going to require your permission and your authorization to move the funds. So we are always there to help guide you, and we will assist in any way that we possibly can. But you are going to have to initiate some of these actions on your own.
Well, it certainly sounds to me like having an advisor, at least in my opinion, would be a benefit because there are questions here that I wouldn't even know to ask. So, as we wrap this up, is there anything we have not touched on? A question that an individual really should keep in mind, but may not even know exists?
It's a good question. I think The caveat I keep suggesting is every situation is different. Every employer plan is different. I think we try to help our clients execute these strategies by getting organized first, showing them all the options that are available to them, talking through the pros and cons of each of those options, and then helping them make an informed decision. And then once the decision is made, obviously just the execution itself still requires a great deal of organization. And that's where Heidi's value to our client relationships really shines, is helping them initiate it, reach out to the custodian, whether that's phone call or online, and say, I want to execute the rollover, providing the account info for where the dollars are supposed to be received, monitoring that transactions are executed to avoid any tax implications, or to do the tax implications in a organized, deliberate way. And then in the end, to make sure everything lands where we expect it to land, and, tie a bow around it and say, hey, client, we can confidently say all the dollars you had over there are now over here. And we think this process is complete. We don't expect you to owe any taxes or experience any tax ramifications. And now we can move forward with your long term goals with the assets.
Heidi, any thoughts?
I just believe in streamlining people's lives as much as possible to make this easy for them. So when you're working with an advisor, they can guide you, they can provide you with suggested next steps, they can be there to hold your hand to walk through it, because it can be complicated and it can be daunting. So that, I think, is why some people end up with multiple former plans, because they don't want to work through the steps. Or they can feel crippled doing it. It can be not the easiest to do. And so that's why we're here to help them walk through it and make it easy.
And I think we opened with, this can be one of the largest kind of financial transactions of someone's life. And if you think about, if your life savings really was in your employer plan and you were a dedicated employee and a dedicated saver, you could be talking about moving millions of dollars, which is no small amount. And we want to make sure we've vetted that process with you, and that you know and have confidence in each and every step.
That can be a daunting thought, moving millions of dollars.
Mhm.
Yeah. So, how can someone reach you?
You can always reach us through our website, www.fosterandmotley.com.
All right. Whether you are considering a retirement plan rollover or you're looking for support with other financial planning, the folks at Foster and Motley are here to help. Don't hesitate to reach out with any questions, and be sure to follow and share this podcast about life and wealth. And thanks for being with us.